Welcome back to the channel, guys. I'm your host, Buckning, and today we are going to talk about how to navigate yourself through the ups, through the downs, through the emotional roller coasters, through the volatility of the stock market, and how to invest in it so that you're not guessing at this whole investing thing. And so if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. But before we get into all that stuff, we'll always give you guys an update on the portfolio here. So today the portfolio closed out at $10,834.58. We are up $122.81, up 1.15%. For the 1 week, we're down $96.91, down 0.89%. For the 1 month, we're up $136.14, up 1.27%. For the 3 months, we are up $694.54, up 6.85%. For the 1 year, we are up $2,036.19, up 23.14%. And for the all, we are up $2,379.35, up 28.14%. So that is the portfolio there. And yeah, let's talk about volatility in the marketplace and how you really should navigate those waters. And before we really get into that, I really want people to understand that this is not a channel where I'm picking stocks for you guys to invest in. And I know a lot of people, that's how they invest. And I hope I can be a bit more educational to help you make better decisions or do your due diligence, do more research on companies that you may be investing in. And so just as we always do, disclosure alert, I am not a financial advisor. This is not financial advice. This is just for entertainment purposes only. I am only showing you what I am doing, and that is pretty much it. And so with that being said, right now the market is crazy volatile. One day it's up, one day it's down. One day, let's say you lose 1,000, one day you gain 1,000, one day you lose 400, and so on and so forth. And it can be a crazy emotional roller coaster. But as I believe, and as many maybe investors believe, hopefully if you're viewing this channel, is we are looking at not buying stocks that are speculative but are a bit more established. And I think in times like this, when growth stocks have taken a big hit, I mean, we're seeing companies take a 30% slash in value in their stock price. And this is where I guess valuation matters. And there are things where people or new investors need to really start doing. And what that is really looking at what the company is doing, how they are producing income, what is their cash flow, and it really comes down to business fundamentals. The stock market, yes, is a place where you can make money, but the stock market is also a place where you can lose money, and a lot of it. I know in the past couple of years, there's been a huge speculation in the marketplace for probably the past 2 years, and a lot of hype around certain things, around certain companies, and people capitalize on that, and great on you for doing that. But now we're in more of a reality, okay? The market is now punishing, looks like, these companies that are not producing what they should be when it comes to actual business. So I'm talking net income, cash flow, and really putting out a product out there. And so we need to start doing our research. And so if you're investing in companies that are not producing a product, maybe for example, Rivian, I know the EV sector is still something that everyone wants to talk about. Everyone's still, there's still buzz around the EV sector. And Tesla is kind of that outlier that has produced a product that is putting it on the market that has really disrupted the automobile sector. And a lot of these already established companies are doing that. They're moving forward. They're changing their technology. They're going for the electric, and they're going after Tesla. And that is really cool to see, because that's what it takes in the marketplace, is competition in a lot of things. We've seen, I think PayPal took a 30% decrease in stock price value. now I'm totally jumping all over the place, but when it comes to that, a smart investor, and there are smarter investors than me. I don't even consider myself an investor, but there are smarter people than me that are looking at this and capitalizing on these high profile names. Because as we've seen in the past couple months, these growth stocks have taken a big cut, a big hit. The market is bringing them back down to reality. And it really is coming down to what the company is producing when it comes to earnings, when it comes to what they're producing, and so on and so forth. And it's becoming, a bit more realistic. And this is where I think a lot of the new investors are kind of scared. They're kind of worried because they don't actually know how to do research in a company, how to read financial statements, how to stay up to date on what's going on in the company, and not using speculation. And I'm going to use, before we understand what that looks like, the definition of speculation is the form of a theory or conjecture without firm evidence. When there's that kind of speculation happening in companies like Rivian, going to put out a vehicle. Yes, I'm sure they have one. They have one that's drivable, but they still haven't sold any to the mass market. And look at what was that other one? I don't know, that other company that totally bombed it and didn't have anything in the works, but it had had a big valuation. And look where that company really went. I'm sure someone will name that company, but it was another EV company. But right now, if you see high profile names, because a lot of the high profile names like PayPal, I think Google probably was not one, but a lot of these big companies were down and are still down, but they are high profile companies. And these are companies that the maybe more experienced person in the marketplace can be like, hey, I bought at a higher price and now it's my chance to do dollar cost averaging to bring that average cost down. And they know what the company is doing because they believe in these companies. Short-term momentum, it will hurt you, but it can make you a lot of money, of course. But I think the momentum is running out. And for a lot of investors, when it's long-term, and I'm talking 5, 10, 20 years out, the compounding effect of that is absolutely amazing. And Amazon is probably a perfect example of that. During the dot-com boom, everyone thought they would change the world, and they were right. They were absolutely right. But it took them like 29 years for them to be where they're at today. And so if you're willing to stick it out for 5, 10, 20 years, based on your thesis of a company succeeding based on their fundamentals or what you believe in that company, then yeah, sure, invest in that company. But I don't think doing hype investing or momentum investing or thinking something is going to just disrupt everything. You really need facts. You really need to figure out what are these companies really producing and what are they reporting, so that you can have a better understanding of what that company is doing, where that company is going, and how that can really grow the company. I mean, we look at Google and their profit margin is huge. Like I think it was like 50% profit margin, and they continue to produce that. And that is an established company already. That does not mean that they won't continue to grow. I'm sure they will. I'm sure they'll find ways to do that. Microsoft is doing the same thing. And those are companies that I think we should really consider. One of the companies that I probably regret not looking into earlier is Shopify. And if we look at Shopify, for an example, and I've looked at them recently, is they are producing heavy cash flow. If you're doing calculations and doing research, they are producing a high cash flow, but they are down, I think, I don't even know, correct me if I'm wrong, I think it was down like 50% from what their high was. But they are a very strong company. They are almost a perfect clone, but not a perfect clone, but very close resemblance to Amazon, just on the Canadian side. And I know they are producing heavy cash flow, heavy margins in their company, but they're using that as like CapEx, and they continue to show that. However, their stock is down. But this is where we capitalize on opportunity. When you do your research, when you do your due diligence, and how important that is, you understand these things, you see these things, and you're not a prophet, but you really have actual evidence that that company will continue to do what it does. And if we look, anybody who holds their positions long term or holds their investments long term always end up winning the end game, because the person that continues to invest, the person that is not trying to time the market but is having time in the market and understanding company fundamentals, typically will outshine a lot of random trading, random guessing, random gambling, and so on and so forth. I mean, we look at Warren Buffett as a perfect example, as everyone does. I don't think they get enough credit for what they do. I think a lot of the new investors kind of look at him as just this old man that hit it lucky, and I'm sure there was a little bit of luck that played a portion in his overall wealth. But you look at that guy, and that guy has held Coca-Cola for like how long? Like not just 20 years, but longer than that. And you can see that. I think Coca-Cola is like paying him huge amounts of dividends, and he just continues to hold it. I mean, he's not shaving down his position on there. And long term, we compare that to somebody like Kathy Woods, as a lot of people did in 2020 and 2021, specifically in her ARK Innovations ETF or whatever that was, her fund. You look at that, and that thing is like down, and a lot of that was speculative. A lot of that was total guess. And who knows? She could be right. She could be right in 20 years. And I will bite my tongue and admit that I was wrong. But you look at it now, the short term, it was great. Long term, it's not looking so hot right now. So no hate towards Kathy Woods or anything. I know a lot of people probably did invest in that and saw great returns. But again, like I said, speculation is not always the greatest. It's all about doing your research and breaking down and really coming to a good conclusion of what the business is doing if you're investing in that company, and really making an educated decision. I mean, like, I'm sure everyone watches Shark Tank or did at some point. You look at like Kevin O'Leary and all those guys, Mark Cuban, and they're sitting there and they're listening to these business ideas that have a product, okay? A physical product that they are trying to put out in the marketplace, and they will only invest if they see the growth in the future, and they're willing to help those guys develop that company and really create something out of it. But a lot of the times, if they don't see the vision, if they don't see any kind of growth or long term, will this work? They don't invest, right? They are really making educated decisions, and they are taking somewhat of a risk, but that is with everything that is especially pertinent to the stock market. But really put yourself in that seat where if a company came to you and was presenting to you their business idea, just like the stock market does, that's what we do. We invest in businesses because we believe in their idea. We believe that they will go places. We believe they'll create cash flow and increase our wealth. If you're sitting in that position, would you invest in that company? Or is it just FUD and they are trying to get some money out of you to do something, and they are not producing results? They are not producing a product. So that is kind of how you should navigate these times of volatility, is really do your research, really look at your portfolio. And I'm not perfect. I don't have an impeccable portfolio or anything of the sort. If you look at the portfolio that we have, like a lot of it is financials, like TD, Royal Bank, Bank of Nova Scotia, BMO. I understand that market. I understand that industry. I understand how they operate. And so I have confidence, huge confidence in what they will do, how they will grow. And that's why I keep on investing, whether they're down, whether they're up. And there are a few companies outside of this portfolio, obviously in the other portfolio, same thing, where there are some companies that are typically on the growth side, but I look at them and I look at their balance sheets, and I look at their earnings reports, and I look at what they are doing this quarter, next quarter, the quarter after. How are their numbers? What does it look like? What are they projecting? And I can continue to have confidence in those companies. Whereas if I'm investing in a company that does not have that, maybe in the past 2-3 quarters, past year, haven't put out a product in the marketplace and are just, still trying to raise money, I don't know if I can invest in something like that. And of course, I could be completely wrong. And again, I am totally open to that. And you can come back and I will bite my tongue and say you were right. So other than that, guys, that is, hopefully that adds some value. I know a lot of it was kind of just mindset stuff, but I hope this encourages you during a time like this where you change up your strategy. You start learning some new skills, like learning how to read financial statements and going through, you know, yearly statements on how the company did last year, what their projections are in the next year, what are their numbers looking like, and so on and so forth, and use that to your advantage in a time like this. So have a great week. Thank you for watching. Don't forget to leave a like and subscribe, because they are completely free, but completely optional, but again, completely free. And have a great week, and we'll see you in the next one. Bye.